Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden language of corporate filings and uncover the real stories behind the numbers. Today we're diving into Odyssey Health's latest report, and let's just say it involves some interesting financial maneuvers that might make you raise an eyebrow. We'll break down what this really means for the company and its shareholders before we dig in, if you like, getting these unfiltered looks into corporate America. Make sure you subscribe and join our Discord community for more in-depth discussions linked in the description below. So what we have here is an 8K filing. Think of an 8K as a current report that companies file with the SEC when really important things happen. It's like a bulletin board for big news that could affect investors. This report is dated August 27th of 2025. It tells us about events that happened very recently that the company needs to disclose. The company we're looking at is Odyssey Health. They're incorporated in Nevada, which is a common state for companies to set up in for various corporate reasons. Their stock trades under the symbol ODYY on the OTC market now. OTC, or over-the-counter trading, means it's not on a major exchange like the NYSE or NASDAQ. This can sometimes mean less liquidity and more volatility. The main event here is something called a material definitive agreement. Basically, the company signed a significant deal. On August 27th, Odyssey Health signed a securities purchase agreement with a fund called Mast Hill Fund. This is the core of the news. So what did they do? Odyssey Health sold Mast Hill a $220,000 promissory note. This is essentially a loan that's set to mature in 1 year, and it accrues interest at 10% per year. Now, here's where it gets spicy. This note is convertible into shares of Odyssey Health's common stock, and the conversion price is set at a discount. It's 85% of the lowest average stock price over the 10 days before they decide to convert. This is a common feature in these types of deals and usually signals that the company might be looking for capital and the investor wants some protection and upside. When a note is convertible, it can dilute existing shareholders as new shares are issued to the debt holder. This percentage discount is quite significant and can lead to a lot of new shares being issued if the stock price is low. On top of the note, Mast Hill also received a warrant. This warrant gives them the right, but not the obligation, to buy 1 million shares of common stock at just $0.02 per share, and this warrant is good for 5 years. What's interesting about this warrant is the mention of a cashless exercise. This means if the stock price is above evol line 10 and cents, Hill can essentially get those shares without paying cash up front. They just give up some of the shares they would have received from exercising the warrant. This is another way to get shares into the hands of the investor without the company needing to immediately receive cash for them. Let's talk about the money. Odyssey Health raised $20,000 with this note, but there was an original discount of $22,000. Plus there were fees. After all that, the actual cash the company got in its pocket was $173,000. The immediate cash infusion is considerably less. This is a common structure to compensate the investor for taking on risk and for the discount on conversion. It's important to see that the real cash received is less than the face value of the note up front. They also spell out what happens if they miss a payment on the note. The interest rate jumps up to 16% or the legal maximum, whichever is lower. This is a pretty high penalty rate and shows the company is on the hook for timely repayment. This section basically tells us that these securities, the note and the warrant, were not registered with the SEC. This means they were sold under an exemption, typically for accredited investors, which Mast Hill Fund likely is. This is where they list the actual documents related to the deal. Here we see references to exhibits like the main purchase agreement, the promissory note itself, and the warrant. These are the specific legal documents underlying this transaction. And finally, we have the signatures. This is the official sign-off from the company's leadership. Here we see Joseph Michael Redmond, the CEO of Odyssey Health, signing off on this report on August 29th, 2025, just a couple of days after the agreement was made. Now let's look at this from a slightly more strategic perspective, a Warren Buffett style analysis, if you will. Odyssey Health, trading on the OTC market, seems to be in a phase where it needs capital, and it's getting it from specialized funds like Mast Hill. These funds often provide capital when traditional banks might not, but they typically do so with terms that offer them significant upside and downside protection through discounts and warrants. The fact that they're issuing convertible debt with a hefty discount and warrants suggests a couple of things. Firstly, the company might be perceived as higher risk by the market, which drives up the cost of capital. The conversion discount means that when the note converts into stock, it's trading, etc. When the note converts into stock, it will likely be at a price lower than the prevailing market price at that time, which can lead to significant dilution for existing shareholders. Imagine if the stock is trading at 0.50 trading and the conversion price is 85% of that, around 0.4025. That's a lot of new shares for every dollar of debt converted. The cashless exercise feature on the warrants also means that Mast Hill can acquire equity without injecting more cash into Odyssey Health, potentially creating a large issuance of shares for the warrant holder without an immediate cash benefit to the company. The net proceeds of $173,000 from a $20,000 to $20,000 note also highlights the cost of this financing. It's effectively a 21% discount on the face value in exchange for the capital raised. This is a high cost of capital. What this points to is a company that might be struggling to fund its operations or growth through more conventional means. They might be in a growth phase needing cash injections, or they might be facing operational challenges that make lenders or equity investors demand these kinds of terms. The critical question for investors in Odyssey Health is how this capital will be used. Is it going to fuel significant growth that can offset the dilution and the cost of capital, or is it simply to keep the lights on? Without knowing more about Odyssey Health's specific business, its industry and its financial health prior to this deal, it's hard to say definitively. However, the terms of this financing are a strong signal about the company's current financial positioning and its perceived risk in the market. The company's direction here seems to lean towards securing necessary funds via agreements that offer investors a strong incentive to participate, even if it means dilution and higher cost for the company. The main risk is if the company cannot generate enough revenue and profit to overcome the dilution and the cost of this financing. The opportunity lies in the possibility that this capital will indeed fuel substantial growth that rewards all stakeholders. Overall, this is a pretty typical deal for smaller companies on the OTC market that need quick access to capital. It shows they are willing to pay a premium in terms of dilution and interest to get the cash they need. Whether this gamble pays off for Odyssey Health depends entirely on their ability to execute their business plan effectively. Alright, that's our breakdown of Odyssey Health's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.